Hi, Tom Lydon here in Chicago at the Morningstar ETF Conference. I'm here with Simeon Hyman, who's Head of Investment Strategy at ProShares. Simeon, great to see you.
Thanks for having me, Tom.
So let's talk about dividend growth strategies. You folks have a suite that represents a whole variety of different asset classes. How is the strategy different?
We take a very simple approach with dividend growth because it's all about finding quality companies, screening for those who can increase their dividends every year, even in difficult financial times, gives you companies with strong balance sheets, strong franchises, a good track record of growing earnings and even cash flow. And all we do is take companies that have very long track records, the longest in each sleeve of the equity world, and the companies that make that grade are simply equally weighted. It's a powerful strategy expressed in our flagship ticker NOBL, which follows the S&P 500 Dividend Aristocrats, a $3 billion ETF. But we also have ticker REGL for mid-cap in the US, SMDV for small cap, and importantly, now that folks have turned their attention internationally, as the economies in the world are improving, developed international stocks have begun to outperform and emerging market stocks have begun to outperform. Attention has been shifting as well to our international dividend growers, ticker EFAD, which is the dividend growers in the MSCI EFI index, and the strategy even works in emerging markets, which is ticker EMDV.
Okay, so we're throwing out a lot of tickers. We've done a bunch of webcasts together on this strategy, which has been fantastic. The key is, in order for the constituents in the index to stay, the dividend has to continually increase over time or at least stay the same.
Yeah.
If the dividend drops, boom, it's kicked out.
Exactly right. In fact, flat is not okay. You have to grow it to be in it. It's a high bar, but companies that have been doing it for a long time tend to stick around. So these aren't high turnover strategies. They're really good buy and hold core elements of your equity portfolio.
So in general, can you just make some comments about carving out those dividend growers and what that means over time, and even make a comment about during certain economic cycles how they might perform?
They're very, very powerful, particularly in turbulent environments, and everybody has gotten kind of complacent about that. But if you go back to the beginning of 2016 as an example, the S&P 500 was down 10%, NOBL was only down 5%. And even in the recent saber-rattling days that we've seen with respect to geopolitics over the last couple of months, those drawdown days have seen very, very good down capture or very effective protection on the difficult days. So yes, you'll give up a smidgen when tech and biotech run, but you'll be real happy you have these when volatility comes around.
And then finally, we're hearing a lot about people pressured about getting that yield and the rising rate environment that we're slowly getting into. Talk about advisors and institutions that are starting to shift more of the allocation from fixed income to dividend strategies because it's deemed to be less risky during certain economic conditions.
That's prudent to an extent,
yeah.
But if you stretch too far for yield in equities, you can get the same kind of interest rate sensitivity you were trying to avoid in fixed income.
Gotcha.
So with dividend growth, you pick up a good yield, you pick up a yield that's growing, that dividends that are growing faster than their parent indices, but you're not stretching so far to get the same problem that you were trying to avoid in fixed income.
Excellent. Simeon, great point. Hey, as always, great seeing you.
Thanks so much.
Thank you.